Lisa, let me start with you about this so-called bull market. Is it for real? Is it going to be sustained? I must say, we have our elves here that follow these things for Bloomberg, various securities analysts, and they think we're going to end up the year at around 4,000. We're now pushing 4,300. Is it real?
Well, we're what we call a skeptical participant in the market, really with a neutral position on U.S. equities. And really, the reason why is you've got a conflicting set of signals going on as far as what may happen with the stock market. So, on the one side, we certainly know that fundamentals have been slowing, whether it's on the top down corporate basis or on the bottom up. Top down macro basis or the bottom up corporate basis. And we have headwinds of continued tight policy in monetary factors. On the other hand, however, we have seen some green shoots starting to come up recently, and technicals certainly have been pushing on a relative basis the U.S. equity market higher. So are we in a new bull market? We think it still remains to be seen, but certainly there is some momentum right now towards an upward trajectory.
Julian, we're going to hear from the Fed next week, and we talk about that tight monetary policy. Is that one of the things that could actually take this bull market back away from us again?
Look, I think just to add to Lisa's points, I think the technicals here have certainly been very supportive of this run. People came into the year very nervous, very concerned about the outlook for earnings. Earnings surprised to the upside, I think, substantially in Q1. And people are sitting there long a lot of cash. And I think, you're going to see risk assets continue to perform here because of the the amount of cash still on the sidelines looking to get invested. It's interesting that you talked about a bull market. Yes, I guess it is now technically a bull market. Up until just a few weeks ago, it was a fairly concentrated bull market. So it's whether it's the top 7, 8, 9 stocks have driven a large amount of that. But I'd say that's started to become more broad-based. So you've seen the small cap, mid cap. Industrial starting to catch up, so it's starting to look like a slightly healthier run as well than the very concentrated run we were seeing just a few weeks ago.
Is there a lot of dry powder, Julian, right now? We see over $5 trillion, I think, now in money market funds. It could come back in the equities market.
Yeah, there's about $5.2 trillion in U.S. money markets alone, around $6.5 trillion on a global basis. It's interesting that the flow into those is still modestly positive, nowhere near the rate that we were seeing money coming into those money market funds around the events of SVB a few months ago, but it's still gradually trickling in. An interesting phenomena there was a lot of stress in the money market complex ahead of the debt ceiling without being resolved. That's really kind of gone out of the system. Now, there's a lot of Treasury issuance coming up in the next few weeks, and our expectation is, the money market funds are really going to take up a lot of that supply.
Lisa, a week or two ago, we were all concerned about the banks as we had that series of bank failures starting in March. There was a lot of concern about liquidity, willingness to lend. Are we through that at this point? Do we still have risks of a lack of liquidity, particularly as we have to issue all those T-bills to make up for what we drew down because of that debt ceiling problem?
We are still really carefully watching liquidity, to your point, David. And the reason why is while we've had a fortunate reprieve in what's going on with financial sector stresses, certainly they are facing potential increased regulatory requirements, as well as really just dealing with general economic slowdown. And so you've got some tightening conditions there. In addition, as you mentioned, the Treasury General account really has to rebuild because they were spending down all of that money during the debt ceiling debate, and they need to rebuild up the reserves. So as they do that, they're going to pull money out of the system. What's interesting is we did just have some auctions starting to rebuild that reserve this week. And the good news is, as we monitored some of the yield activity around those auctions, we didn't see any concerning signs at this point. But it is very early days, and there's almost about $1 trillion that's expected to come into the TJA coffers and out of the market really over the next several months. So that's something we'll just continue to monitor.
I think this part of the rally we've seen in the last few weeks is people getting increasingly comfortable that the bank situation seems to have stabilized somewhat. And that's certainly been true in the near term. I think the short-term liquidity issues have been somewhat put to bed, but I think we're not out of the woods yet. I think there's still going to be continued pressure on the banks on a whole variety of levels. I think net interest margins will remain under pressure. I think credit quality is going to continue to become under pressure. We're still in the early innings there.
And Julian, you're just fresh back from Berlin, a big conference over there that was more private oriented, I think. What about private credit? Is it going to step in wherever we need it for the banks?
Look, I think a lot of questions around this topic. Everyone, as I go around the world, not just in Berlin, but Middle East, Far East, a lot of interest in private credit, of course, here in the US. Questions being asked about, is that getting overinflated now? Is there too much excitement, too much money going into that? And I would say, look, it's great that it's there as an alternative source of capital at a time like this when the banks, the broadly syndicated market, at CLO market's not really there to provide liquidity, so they're able to step in. And I think there's still a long way to run. I mean, it's still only about about 7% of the fixed income market is private credit, only about 2% of global AUM, only 17% even of alternatives. So we still think that private credit market has an opportunity to continue compounding, circa 20% plus growth rates over the next few years.
Lisa, even apart from the private credit market, where do you see opportunities in fixed income right now, particularly?
Well, we think there's actually a number of interesting opportunities in fixed income. And while overall yields really are much higher than they were a year ago, if you look into specific sectors, there really are some very additional opportunities to pick up yield. So one area, for example, that we are advocating heavily with our clients is an area called reinsurance, where basically, as an investor, you're really helping to pick up some of that insurance risk, but in turn get paid a hefty premium in the property and casualty area. And what we're seeing right now is really not only that nice incremental yield, but there's actually just a lot of pressure for those prices to continue to be very attractive for investors simply because there's a lack of capital in the sector. So that's really one area we're interested in. Another one really is an area called non-agency mortgages. And so here what you have is actually still fairly strong fundamentals underpinning some of these borrowers for very large mortgages that are not necessarily guaranteed by the agencies. But again, very strong yields that are supported by borrower repayments.